Our next guest says that the central bank already has overshot and should have stopped raising rates back in January. I want to bring in Campbell Harvey, who is a professor of finance at Duke's Business School. And Campbell, we've spoken with you in the past. You are pretty convinced that the Fed has completely overshot, that inflation's already below 2%. What tells you that?
Yeah, I know it seems a little odd to say inflation's below 2%, but you need to look at how the CPI is actually constructed. The largest component is housing. It's more than a third of the CPI, and it operates with a lag. So what's reported in the CPI today is housing inflation from last year. So the housing inflation is over 7% in the CPI today, and that's why the CPI is over 3%. But we know in real time, housing inflation is not over 7%. It's maybe 1 or 2% or even zero. So policy needs to be determined based upon real-time data, data that's forward-looking, not data from the past. And if you look at real-time data for shelter, that means inflation is running about 1.8%. So this idea that, oh, well, we still have a long way to go, that's just not the case. That is a false narrative.
Campbell, you sound pretty worked up about this, and I think it's because you are worried that there are some big problems to come with the recession and with problems in the financial system. What do you see?
Yeah, so recession at this point is a self-inflicted wound. And if you look at what's happening, the tightening is very severe, and it's not just a short rate going up so quickly. It's the long rate, too. So often with yield curve inversions, what happens is that you uninvert when the short rate goes down. And uninversions happen before recessions, the last 4 recessions. But in this particular episode, the long rate has gone up, and the long rate is very damaging. It increases the cost of capital, so it makes it difficult for businesses to invest. It craters the housing market with mortgages all of a sudden at 8%. So this causes implications, and indeed, our financial system. So our banks are taking a hit right now. You'd think it was bad in March with SVB and other banks taking a hit because they invested in kind of longer-term instruments. Well, that's when the long rates were 3.5%. So now they're over 1% higher. And we have not realized all of these losses yet. So all of this points to weakness in 2024.
For those of you who don't know, we've had Professor Harvey on before, but he is the one who first pointed out that an inverted yield curve is a signal of a coming recession. People have said, okay, it's uninverted now. Does that mean we escaped it? You're saying no way. It's going to be worse than ever.
So again, if you look at the last 4 recessions, the yield curve uninverts before the recession starts. And again, this particular flattening that we've seen is like the bad scenario because long rates have gone up. And when those long rates go up, it really puts the brakes on the economy. And I know it's confusing because GDP print was 4.9%, which is very good. And this is purely consumers working through excess savings from the pandemic. Those savings have run out, and we can see it in leading indicators like delinquencies on credit cards and auto loans. Those are going up, which means the savings have been depleted. So we cannot count upon the consumer bailing out the economy in 2024 like they did in 2023.
We had Steve Eisman on from Neuberger Berman yesterday, and he's been really good about the banks and his calls on these things. He says that, look, the banks are going to earn a lot less money, but there may or may not be some sort of financial crisis that comes down the road. He seemed a little more sanguine about it. Why are you so convinced that there are a lot more Silicon Valley banks out there right now?
Well, just look at the data. So I challenge your viewers to go and ask, what is the interest rate you're getting on your savings deposit? And you'll find, if you're at a too-big-to-fail bank, that you're getting 2 basis points, maybe 5 basis points, when interest rates are over 500 basis points. And that, to me, is a red flag. If they can only afford to pay 2 to 5 basis points on a savings deposit, what does that mean?
Well, it's not what they can
Deposits
afford. It's
flee.
what they have to pay, because there were so many deposits that made their way to the too big to fail banks, to the big banks, because people were concerned about the smaller banks and the regional banks, and money left those places because there was a concern about safety.
And money is leaving those places right now because you can easily get over 5% in a money market fund. So there's a drain on that capital from the banks, and that will work its way through in squeeze credit in 2024. It's just yet another dimension in terms of the slowing of the economy. But nevertheless, the spread between like 5 basis points and 500 basis points, that's historically unprecedented. And to me, it's a sign of the weakness in the banking system. And the next time the Fed releases data for the third quarter, we'll just see how bad it is, to see the losses on the hold to maturity bonds and available for sale. It should be very interesting. The point I'm making is that Silicon Valley Bank was not a one-off. There are many banks. Indeed, we've estimated perhaps 10% of all banks look pretty similar to SVB. So this is not a one-off, and those long rates going up is punishing. When those commercial real estate loans come in for renegotiation, you watch out. The banks would like to renegotiate, but given the level of rates, this will just ripple through the economy in a very negative way.